The Hedgeless Horseman here. It's June the 18th, 2024. First of all, thanks to the sponsors. Let's look at some Twitter posts I saw actually just now. Here's from Brandon Balo, who shares a chart made by Scotia Bank and Schroders. Gold equities are the cheapest they've been in over 40 years. Most gold equities deserve to trade at a discounted NAV. Your job is to find those generating tons of cash. I mean, that's more producer type company, obviously, but still. I guess it goes to show. I mean, here I guess we have 2015. Here we have 2024. So it's like, for people who followed me for, let's say, at least several years, it's like, I've been getting increasingly bullish over the last, I would say like 2 to 3 years, which also means that, you look wrong, more and more wrong, because I thought juniors, especially the ones I liked, I thought they were cheap 2 years ago. They just got cheaper. 1 second, I'm just going to close the window. Because I'm not a market timer. If I find a company I think is cheap, it's a buy. And I could find quite a few I thought were cheap 2 years ago. I find some all the time because I'm always fully invested. I was fully invested at the top here in 2020. I was, fully invested at the bottom here. And here's 2020, I guess. I was fully invested here at the exact low. I was fully invested here at the exact high. So that's why I have, huge swings, because I just buy and buy and buy, and then I do the value shuffling. I think that my portfolio should at all times be made up of companies I think are undervalued, and I don't really care what the sentiment is. The sentiment just, let's say, if the sentiment is low, it means there's probably more cheap companies out there. If sentiment is high, you have to really work to find something that's probably cheap based on its long-term fundamentals, and especially at the present moment, because it's hard to find at the highs. When sentiment is high, producers tend to be overvalued in the sense that they are pricing in a metal price that's actually higher than where it is. And at the lows, problem at the lows is typically they don't make much money, so there might be actually a risk of bankruptcy. But then if you're buying producers in that case, or beta plays, meaning developers who have a project that aren't even economic at those prices, you're betting on the metals going higher sooner or later. So that's obviously quite speculative. But the point is, there's like, hey, just looking at this chart, it suggests that yes, miners are very cheap and have been for quite some time. And here we have a period where you see they were actually highly valued, which is very interesting, I would say. Obviously, that's a big swing that you go from, let's say here, might be almost averaging 2 times NAV, and here you're down to 0.5. So that's a 4x just to get back to 2. And that's, that's some really good swings there just from sentiment perspective, what price people are willing to pay, how much they appreciate miners, for example. If you can add some value creation, that's where the big money really is, right? You buy something that when it is really cheap, if it has a way of also, getting a 4x is good enough, and even if that takes years, just from a sentiment swing, let's say. But if you get some value creation going, if the company doubles in value and it's selling for a fourth of what it could be valued at in the future, just based on the value at the time, if they double the value, then one could say, okay, I could get an 8x return. it's a multiplier effect basically. Sentiment is the behind the invisible hand, I was gonna say. That you don't even need to do anything with a project and it still can go up 4x and down 75%. And that's going to happen at all times. I mean, it's not like these swings were absolutely huge, down to, 1.34 up to 2.3, but it's still a swing. And you can see how much it swings, how much the appetite, let's say, for risk, how fear and greed. I mean, that's why it's going like this. And we simply are in a period where there's, yes, it's volatile, but it's still, on average, is relatively low relative to what it was in the past. And this is not like ancient history, really. But yeah, I mean, the sector peaked here, and I mean, some argue that we have been in a bear market since 2011. And this chart kind of suggests that could be the case, because after 2011 it just dropped. We had a brief spike. I think this was the rally in 2016. Went lower. So this has been trending down kind of, and this looks, I don't know, some kind of bottoming phase, like this was a very long topping phase. So I mean, personally, I think I know where we are, right? Everybody hates gold miners. Everybody hates, especially gold miners, I would say, and especially juniors. And there's no time there's no period, let's say, in history where that has stayed true forever. And the same goes for when they've been hot. They don't stay hot forever. So that's the big move that's going to come one day. That's why I'm fully invested. I mean, that's the big thing. I don't know when it's going to happen. It could play out over years and all that. But just to catch one of these sentiment moves, if you buy really good companies, let's say, if you're relatively good at stock picking, you can buy them cheap. Next 3 years, who knows? Some of them might be up 8x, some might be up 15x. And that is not unusual. That's what typically happens when you go from a bear to a bull. This is an interesting article. It's June 18th. Did I say 17th? No, I think it's June 18th. For more than a year, Annie and I have been investigating the dirty, deadly Indonesian nickel industry and the supply chain connections to Tesla, GM, Ford, Hyundai, and every other EV manufacturer you can think of. Excuse me. Unfortunately, it's behind a paywall, but you get the gist of it. I mean, you can see the pictures here. This is obviously good for any, let's say, any nickel company out there that's not doing nickel production as dirty as this. I mean, when you read stuff like I think it's actually in the, it's in the Bloomberg. It's on Bloomberg.com. So it's a big, well-respected financial website. So people are gonna read this. You don't know what's gonna happen, but it's like this is probably gonna get, I think, more and more attention. So I mean, that just makes me like, let's say, Magna and Stillwater, for example, even more. Because if companies are getting forced, and it's not like it's gonna happen overnight, but this is like a free option in a sense, because now they're priced like we're in whatever equilibrium, that nothing's really gonna change. There's not gonna be a push. Indonesian nickel is gonna flood the markets forever. Nickel prices are never gonna go higher, yada yada. Still, you see very large companies buy nickel in Canada. And the US, I mean, you have the strategic angle, first of all. The nickel is very strategic, and we know that, for the war effort and all that. And we know that, hey, the US has one still operating nickel mine. That's it for a $35 trillion economy. So you have both the strategic aspect, and then you have the ESG aspect, the green aspect. And both of them are favoring, obviously, Western located nickel deposits that will not be, let's say, shaving off hectares and hectares and hectares of rainforest to chase a meter thick seam of low grade nickel. So this is kind of we have this in the backpack. If nothing happens, well, right now everything is priced like nothing is gonna happen, like there won't be any changes. So this is kind of I like when you have some aces up your sleeve. That's like, okay, I'm not paying for this to happen, but it could happen and have an effect. In that case, I'm gonna get the full benefit. If nothing happens with this, if nobody cares that Indonesian nickel is dirty, there's no, let's say, limitations or higher standards on where the nickel is sourced for Tesla, GM, Ford, Hyundai, etc. Well, I didn't pay for it anyway. So at face value, there's no value, there's no price risk to it. It's just price upside. Because if it's priced in at zero effect, if it happens, it's going from zero to actually happening. So that's obviously something that's got to be baked into the long-term risk reward one sees for, let's say, nickel players in North America. And Europe is doing the same thing. BHP is getting into, or has gotten into Sweden late last year. BHP is also getting into Finland and Norway, mostly I think for nickel. That kind of, you can see what the big boys are thinking, where this is headed. In the junior space, none of that is reflected. And I've said this before, even Agnico invested in a nickel company in Canada, and that's the second or third largest gold miner. I don't think they're dumb money. Look at the Agnico stock price. Another one from Brandon. McKinsey, 46% of US EV owners want to switch to ICE vehicles. So this, I guess, is or one could say is a take against nickel, but pro PGMs. The good thing actually is that, well, a lot of nickel juniors, like Magna, like Stillwater, like Fathom Nickel, they have both nickel and PGM. So it's kind of internally diversified in that sense that, okay, let's say demand for nickel goes down in EVs and nothing happens with the ESG front or strategic front. Yeah, nickel prices can continue to suck for a while. But maybe PGMs do better. That's I think the interesting part, and that's why I think someone said, I think it was a metals trader, a guy from one of the big metals traders, and he said, like, Glencore was kind of built on polymetallic deposits. Glencore really likes to be internally hedged. Obviously, most gold companies, they have gold, that's kind of it. Silver juniors, a lot of them have silver and gold, or silver, lead and zinc, and that's seen a lot of times like, oh, they're not a pure play silver play, for example, but that can actually be very good at times. I mean, let's say silver sucks, but zinc and lead are doing fine. And in the case of a lot of the nickel, PGM, copper juniors, or nickel juniors as people view them, a lot of their revenues come from copper and PGMs, and even gold. But they're kind of, and you see this right now, if they have kind of nickel in their name, if the retail sector views them as nickel, or anybody really who has capital and is playing in the market, if they're viewed as nickel plays, nickel sucks, that's it. They're gonna be cheap because nobody wants to own anything related to nickel, even though nickel might be, let's say, 40% of their revenues. 60% might come from other stuff. Let's say the other 60% does well, or there's a lot of risk to the upside for the other 60% metal mix. that's not going to be reflected anyway. So I guess what I'm saying is I think one of our biggest edges, and it typically comes with having a longer time frame as well. It's like figuring out what is Mr. Market? What is Mr. Market thinking? Because the Mr. Market tends to only look at one thing at any point in time. Either it's like, the flagship project, which happens pretty much all the time, and that's, as I've said 1,000 times before, that's why the Lundins like spin-outs. Because they know as soon as they have two good projects, let's say, in one company, they're not going to get much value reflected by Mr. Market for the secondary asset. And they spin it out like NGX was spun out. NGX spun out Philo, I think. Now they have a combined market cap of 4.5 billion. If they were in the same company, they would have a lower market cap. That's just from forcing the market to actually appraise one thing at a time. Because that's the only thing it can really. And the same I would say goes for themes. Let's say, this company, what's the dominant emotional view, let's say, of Junior? Oh, it has to do with nickel. And I think nickel sucks, so I don't like it right now. And, you can see that on the commentary from folks. Oh, I think nickel is going nowhere. Let's say they comment on a stock they don't own. Let's say it has, again, to do with nickel. That's it. They think nickel sucks. They think nickel is gonna suck, so they're not buyers. And if somebody owned the company and they get convinced, by the prevailing narrative that nickel sucks, nickel is gonna suck. So why own nickel juniors or miners? That's what people tell me. So they sell. And I think that's how simplistic the market can at times be, or a lot of the time actually, because that's how we work as humans. I can't keep in my head when I look at a company. There's one dominant thing about the company that either makes me sell it or buy it. But most companies have many other angles, maybe other projects, maybe other risks to the upside. Maybe they have a basket of commodities, like they have PGMs, nickel and copper. Then the value of that is actually going to be affected by the prices of all those metals. But I might be looking at just one metal, and that's the dominant theme in my head. It's like, oh, it's nickel, so I don't want it, let's say. But if you can look past that, that's our job, kinda. Look at stuff that the market is not looking at. Figure out how that can affect the case, because if it's not priced in an upside scenario, let's say, you're getting, at face value, you're getting risk-free reward potential, because the market isn't even looking there. It's not even factoring in that could happen. That's great. And typically, with everything, things take time. This ESG thing, the green nickel, is that going to happen tomorrow? No, if my time horizon is tomorrow or I'm a trader, it doesn't really matter, because the odds of it having material effect to the case one day forward is almost zero. So all of this stuff needs time to potentially play out, and that's why you kind of have to, in my opinion, the biggest edge then is a longer time frame. I'm buying now. If I think this price is cheap today, I'm buying now, and the simple case is that within, let's say, 1 or 2 years, these things that the market is not focusing on could happen. If they happen, what I paid 1 or 2 years before is going to look cheap, meaning that the market is probably going to price this higher in 1-2 years when said things could have happened, if they happen. It's a pretty straightforward thing, I would say, nothing real to do with trading. And in the meantime, of course, you can have the volatility, like, oh, a stock goes up, who knows, 30-40% because of sentiment change, and you might take some money off the table, because all things equal, if there's no value change really, and other places you see they have this same value gap, but their price, the price of those companies didn't just go up like that. You have the potentials for value shuffling. But the easiest, and I was going to say, I mean, what cases can go up in price over 5 years? And even as a value shuffler, let's say, you don't really sell much. I mean, they are the ones where value is going up with price, but the price to value gap never really closes. In that case, you don't really have an obvious reason to sell as a value investor. If there's continuously a gap, value marches higher, price marches higher, but they're still cheap because price is not catching up to value. I mean, those would be the simple ones. The harder ones are where value has gone up, but like price actually overshot by a lot. Maybe in that case, I mean, it actually makes total sense not to hodl and to do some value shuffle. Gold is. What are the metals doing today? Gold down a bit, silver down a bit. It actually did pretty. I mean, it was close to $30. As always, I was gonna say. I mean, not much has happened really in gold and silver, but you see sentiment. I mean, change a lot. So there's like multiple bull and bear markets. I was gonna say just in or. 1 second. I mean, gold we're at the same price we were back here. Still not too far off from all-time highs, yada yada yada. But here people are gonna write like it's a bull market, here a bear market, bull market, bear market. That's again just how it is. Why I don't let it affect me. One I do want to talk about also is First Nordic. Quite an interesting day yesterday. First Nordic put out news release. First Nordic identifies new multi-kilometric gold anomaly and returns highest bot drilling grades to date at pullback. And bot is base of till drilling. So basically where you drill through the till cover and sample a bit above the bedrock and a bit in the bedrock. I mean, it's basically like to find out, hey, is there a gold source in the area? Because in the actual till, you're going to find eroded. If you find gold, that means it's been eroded from somewhere. Because it's the ancient ice flows that basically scraped off the bedrock. So if there's gold in the bedrock, that gets scraped off, gets put into the till. Then you also have like, okay, you can actually, I mean, that you drill into an actual, let's say, ore body, that you take just a snippet of the actual bedrock that has not been eroded. That's actually what's present right now, and you hit, gold in that. So I mean, they had, where is it? But if you find 5 grams per ton in bot drilling, that's not something you see every day. That is obviously highly anomalous. It's like, it's kind of, you're blind drilling and you hit 5 grams per ton. That is very interesting. I mean, what does that mean? I guess there should be a source nearby, because I'm thinking that either they're actually in bedrock. I'm not 100% sure what part of the till sample returned the 5 grams per ton gold. Regardless, either they actually hit a source, or there should be a source very nearby. Because I have a hard time seeing that those concentrations show up if the till has been moved. I mean, it's possible, but it's just so extremely improbable. Let's say the ice comes, shaves off a gold vein. Let's say it moves it several kilometers. and that means a lot of a lot of friction, a lot of churning, a lot of scraping, which would be dilutive. So if it's moved kilometers away from the bedrock source, would you expect to find 5 grams per ton concentration in just a small drill hole, drilling blind? That must be extremely unlikely. Unless you hit literally get a piece of the vein, if it's till material. But what are the odds that you're gonna hit with a drilling blind, long way from the source, and actually literally pinpoint hit pieces of a gold vein? That just sounds extremely unlikely. But now we're up to the Brokoyan Harpsund anomaly. This is gonna be poor resolution, I'm pretty sure. Yeah, you gotta go to the website to find better resolution. I can't even fully see the scale bar, but I think this is 5 kilometers or something. So this is a semi-continuous, 5 kilometer long geochemical anomaly. This is the IDA target. That's where the discovery hole was that had gold line go to 70 million a few years back, and that has been extended, I think, for extension of bedrock anomalies along the IDA structural target by approximately 1 kilometers to 1.5 kilometers. Now tested and confirmed for gold mineralization. So up to the point that they have stepped out, they've confirmed gold mineralization. So I think this is still open, and this was a very limited campaign because Goldline didn't have much money. So everything is kind of, I think there's going to be we're going to do a lot more bot drilling and stuff than we have, because they did it on a super small budget. We need to flush these large targets out. So there's, I think, going to be more bot drilling when we get money, and also I think they're going to be wanting to drill. And Taj has said that he thinks pullback in an IDA deserves 10,000 meters, and we drill for very cheap costs or low costs in Sweden. So there could be a lot of drilling, 10,000 meters for a few million. And that brings me to another point. Well, first of all, okay, what do we have now in First Nordic? We have the Barsele project. It's a multi-million-ounce system. Probably, if you listen to Taj, for example, he thinks 3 to 4, very probable, could go to 5 plus. I guess that depends. How deep do you want it? You want to drill it, because based on geophysics, it could go to 2 kilometers. Then if they end up drilling that, I think it could be even more, because you're not even really factoring in the strike potential as well, or the Riesberger target, or anything in between that Agnico is kind of prodding around with right now when they're drilling. So you have the Barsele project. That's the bird in the hand. The bird in the hand is a multi-million-ounce gold deposit that I think is a very robust gold deposit. Higher underground grades, most of it is underground, very wide widths, typically 10 to 100 meter wide, so that's perfect. I was gonna say it's not narrow vein mining. It's not, we're gonna take huge amount of dilution and then it pinches and swells and whatever. I'm thinking let's say pure gold, stuff like that. It's let's say somewhat inconsistent, narrow vein, so there's just a bunch of uncertainty, let's say. No, these are really thick zones. This is what you want, bulk mining underground, and the grades are higher than Ikkari. They're much higher than Björkdal. So if Björkdal can make money, some form of money at least, with their 1.5 grams per ton, even if they were, let's say, cash flow neutral at 1.5, and Barsele's 2.7, that's 1.2 grams per ton. That's pure profits in that case. So we have all the analogs, let's say. Everything points to the Barsele underground deposit being very economic, or Barsele in itself being very economic. And think of that in that case, that right now it's like a 2.4 million ounce economic gold deposit. And I'm saying economic. I think this is going to work at $1,800. I think it could work at $1,600. We know Agnico did the resource at assuming $1,300 gold. So everything in the resource right now is assumed to be making money, or at least not losing money, at $1,300 gold. That's what the cutoff grade, or that's what it means when they do the resource at $1,300 gold. And that this is Agnico doing it. This is not some run of the mill. This is probably the best, highest quality, sharpest gold producer in the world that did a resource at $1,300. And they, by definition, are conservative. I mean, if you look at their cost estimates, they're much higher than Björkdal. They're much higher than, well, they're higher at least than Ikari and all that. So again, if it works at even with inflation is not that bad that something that worked at $1,300 gold in 2019 wouldn't work at, I mean, especially at $2,300, obviously. But like maybe, who knows, maybe that's up to like $1,600. They would do it at $1,600 today, maybe. Then we have a huge margin of safety anyway in Barsele. Okay, this mine makes money down to, let's say, $1,600 gold. Then it's like even Steven, neutral. That's the bird in the hand. All of these other targets on the 100% owned ground, which Barsele, the company, didn't own, Goldline owned it, now it's in one company. That's the gravy on top. And this is some huge gravy. These are multi-kilometer long grassroots targets. It's like the Harpsund Brokoyan target, that's a longer strike than the footprint of the Barsele deposit. Of course, that doesn't necessarily mean it's like this is a 5-kilometer gold system, because you know some if it's a geochemical anomaly, let's say, it's also been moved in a sense, because the till has an ice direction, but at the same time, if it starts up here and it's been dragged down here, it's like you take a 5-kilometer smeared zone and then just move it back to where it could have originated, let's say. So it still suggests that there could be a big gold system here. I think some believe that Barsele is not even going to be the largest deposit, but it's like Barsele alone. That's a company making that's a good project. That's in my opinion a tier 2 project. At least it's gonna be because it's probably gonna be 3 to 5 million ounces, not 2.4, because 2.4 was done again at very, very conservative gold prices, conservative cost estimates and all that. So I mean, they could redo the resource today and have a $1,800 gold price. And if a junior put it out, they would obviously be more aggressive than Agnico, yada yada yada. So that's the bird in the hand. And in my view, and this is, I did this, for example, I've been doing calculations because Agnico has not put out a PA. First Nordic, I don't think are allowed to put out the PA because Agnico are the operators. So we have to, and that's the beauty. I mean, again, goes back to like, okay, what is the market thinking, seeing, whatever? Can we figure out something that the market doesn't see, let's say? So I decided to do, for me it was relatively easy to see First Nordic is undervalued simply because, again, Agnico did the resource at $1,300 gold. It's a multi-million ounce project, extremely good infrastructure in Sweden, tier 1 jurisdiction. Sweden is getting better, and it could grow to 4 or 5 million ounces. So in that case, it's like a tier 2 project with extremely good infrastructure in a low cost area. Yeah, I mean, how long is that list? How many do you know like that? We know Snowline recently put out 7 million ounces. They are the opposite of having extremely good infrastructure. The hurdle to actually develop that is very high, but it's a world-class deposit. But the point is, up there you need like 7 to 10, you need a tier 1 project to even, given how the infrastructure situation is right there. But back to the point. So according to my personal estimations, and these are obviously not going to be 100% like reality. I mean, no PA studies translates fully to reality, not a PFS or anything like that. But we do again have some analogs. We know that Björkdal has been mined since the 80s. We know that Kittilä, for example, makes a lot of money on like 4 or 5 grams per ton of refractory gold, and they're down to 1 kilometer depth at least, I think. So we have a lot of evidence that this metallurgy, these grades, these widths should make a good mine. But I want to be conservative, because especially if I'm betting big, I don't want to buy something that is like only really cheap at today's gold price, or you have a very aggressive scenario. So I did a bunch of different assumptions, like what the operating cost would be, what discount rate. I mean, I see African juniors put out PEA with 5% discount rates. Most in Canada and US or whatever, I mean, they're gonna have it at 5. I mean, maybe some have it at 8. I mean, the riskiest jurisdictions can have 8, and that's not even everyone that is in a highly risky jurisdiction even uses 8. Okay, let's make it conservative. It's like, I want to know that what I'm buying is robust. It has actual legitimate value, not one of these projects where this crappy project, yes, it works at $2,500 gold. It only works, let's say, in the high of a cycle, because that's not a good project. Okay, it makes money 3 years, loses money 5 years, then makes money 3 years, you know what I mean. So I wanted, in order for me to really feel comfortable, like I'm really getting a steal, I want it to be a robust project. Like, yes, this is actually one of the few legit multi-million ounce projects out there that would be a great benefit to anybody who owns it. So and that's why I used 8% discount rate, higher OPEX than Icari, and $1,800 gold. And with those, I think, quite conservative assumptions, I got, on a fully diluted basis, I got the implied value for Barsele belonging to First Nordic. And this is based on 2 million ounce production, not the 3 million, not the 4 million, not the 5 million, right? So this is just for the conservative version of Barsele at conservative, let's say, cost estimates, high discount rate, low gold price. I still got the value for Barcelona at $366 million and at a 45% interest. So this is like, in my view, it's like absolutely base case of what this, what First Nordic has. Because again, this does not factor in any upside exploration, not even around Barsele, and none of the potential at Påbacken or Storjuktan, for example, which is 100% owned. None. It assumes no other success happens than what has already happened. And then I get $1.62 per share, fully diluted to First Nordic. If I use the Rupert price to MPV, and I did, I adjusted the gold price down to $1,650 for Barsele, for example, because Rupert also has, I think, their base case might actually be $1,650. And then looked, okay, what is Rupert trading, price per NPV at $1,600 gold? And then I got, so it's kind of reflecting the sentiment, right? That Rupert is not priced as the value of the, or what the NPV suggests the value is for Ikari at 1650, for example. So then I took, what part of that NPV is priced in Rupert, and I used the same sentiment discount, let's say, for on the NPV I got for Barsele at 1650, and then I get 84 cents, $0.84 fully diluted for First Nordic, and I didn't even use fully diluted actually on Ikari, so this price is actually higher, I think, for First Nordic. Still, that's 84 cents, and we're at 32. Just to get it in line with, like, I mean, it's still cheap, but just to get it to reflect, okay, what are some other projects? How cheap are they in this poor sentiment environment? Just to get to, let's say, Rupert sentiment discount. Would be, how much is that? %164. But that's the thing. Rupert also has the benefit of, we can actually put out a PA study. We don't have that tool for First Nordic, so we have to figure out, and that's, I think, the beauty right now. Because if everything was obvious and the market had an easy time to figure out what fair value is, like how much is this worth, it's going to be much harder to find an actual opportunity. So it's like, even though it's sometimes frustrating, that's also the main tool. If we something before it's obvious to the market, that's how we can make money. That's how we can beat the sector. We're a bit smarter. We're a bit more forward-looking. I'm not going to even say smarter, but it's like we do the work. Let's say we figure out stuff that the market will figure out someday, and when they do, we get paid and all that. So this is why I'm quite comfortable to have a large position in First Nordic. Actually a very large position, because I'm playing, this is a long-term case for me, or that's what the case is. I mean, if, let's say, First Nordic opened up here tomorrow at $2.3, obviously the case changes a lot, because all of a sudden, okay, the value of Barsele at $2,000 gold with 8% discount, higher open, still conservative, but like, okay, gold price at 2,000, all of a sudden that's priced in. So now I can't steal the value of Barsele anymore. I'm getting a call. Now I can't steal the value of Barsele anymore. So it doesn't necessarily have to be a long-term case, if you know what I mean. If the market got its act together tomorrow, then my holding period could be 1 day from now. But that's not how markets work. Like we've seen, it's a a climb, let's say. Gradually the market gets comfortable with the idea that it's like, yeah, it's probably worth a lot more. Then goes up a bit, and then people are like, I'm going to take some profits maybe. It's like, oh, it has run. You have the doubters, people waiting for dips. Then dips a bit. Then some people, well, now it's too cheap, so I'm going to buy. And the people waiting for a dip are going to buy, and then it goes up. And then we might have some profit taking. People get more and more comfortable. That's how it works in reality. That's how when you factor in psychology, that's how it works. So even if you are absolutely right, the payoff comes over months and years. But that's why I don't care much about the short-term volatility, because this is the upside I'm looking at. I'm not in First Nordic to make for it to go from, let's say, 20 cents to 38 cents. That's a good return. Don't get me wrong, that's a very good return. You would be happy if you got returns like that, even if it took 2 years. No, I'm aiming big, so I can also kind of miss big. And if you have a case where you can aim big, and let's say you have a sizable position, if I'm somewhat right just on this case, and I ride it with a pretty good position, that could pay for 10, 15 other juniors that I ended up looking wrong on. But even more to the point, let's say, on June 14th, First Nordic announces repricing of warrants and warrant exercise incentive program. The warrants have a placement that closed 15 2022 and April 2023. These were private placement of Gold Line, yada yada yada, and Gold Line was of course merged with Barsle. Anyway, so they changed at the time. I don't remember exactly what the First Nordic was trading at. Maybe 31 cents. So it's like, okay, the idea here, as far as I can tell, is like there's, I think, around $4 or $5 million worth of warrants in the money around these prices. If they can get people to exercise their warrants, meaning giving the company money so they get a share, or in this case they amended the terms. The warrants have a current exercise price of 34, and the company tends to amend the exercise price to 29. I think they also get plus an incentive 1/2 common share, because let's face it, I mean, if the share price of a company is 31 cents and your warrants are 30 cents, that's a 1 cent spread. That's not much of an incentive in a sense. You could almost buy it at the same price in the market without any having to go through the paperwork and yada yada yada. So now they add here a 1/2 common share as an incentive. It's like you don't only you get a benefit of converting. You don't only get the shares, you also get a half a warrant. That's to make people exercise the warrants. These warrants are worth more now to exercise after the amendment. And the 29 cents, that means at face value, if you sold at yesterday, if you sold at 34, let's say, to pay for the warrants exercise, to pay for the warrant exercise at 29, there's a 5 cent spread. So you kind of book that profit at face value, and you get half a warrant. So this is to speed up, and we only get to July 7. So they want the money in now. So they're aggressive getting the money in. In that case, we don't need a private placement. Depending on how much they raise, they get in, we might not need a private placement. And then the beauty is, of course, that let's say they get $4 million in. $4 million. They could do a lot of till sampling. They could maybe drill 10,000 meters as well at pullback. And of course, the drilling at Agnico and all that pertains to the Barsle project, that's fully carried by Agnico. In that case, like, there won't even be a private placement, because that's, as we know, tends to, let's say, limit the price action of a stock. Usually it actually brings it down because people are expecting a private placement. And in that case, the ones that want to be in the private placement want this as cheap as possible. So they're going to be selling the stock. And even if you had, let's say, you have 50,000 worth of stock and you think they're going to do a placement, well, you could sell your $50,000 worth of stock and buy it back at lower prices and maybe get a warrant. So that's why that's why you see these absurd sell-offs sometimes in juniors. But if they do this based on the warrants that are already here, there won't be a private placement. They're getting the money in from the holders of the warrants. And now look at what happened yesterday. 8.36 million shares traded. And that's just from TSXV and ATS. I don't think that captures in the volume in Germany, for example. So there was insane volume yesterday. And if we look a bit closer, okay, what happened here? Because the news was all obviously good. News was obviously good. It opened up here because it was ripping in Germany. I think it was up 25%. It closed down here, was at a time down here. Okay, some things to note. Again, it's like almost nobody is a long-term investor in this space, not even a long-term speculator. But what we have here is like, this is a gap. I'm pretty sure this is considered a gap. And this is for traders. So here, because for some reason the market tends to want to close gaps. You can see pretty much no gaps all the way up here. But here you have a gap. These tend to close. The price, not always, but traders tend to jump on because they assume, and they obviously help it materialize, to get this gap here to close, meaning to get price down here. I mean, first of all, when it opened up, the gap was obviously huge because this was the highest price paid the previous market day, and the stock opened up here. So here you have a huge gap to close. And it seems that the yesterday's action actually closed not only the daily gap, but also the previous gap, which was down here, because this here is a gap. I should maybe do it like this. So this was a gap. When it opened up yesterday, this was a big gap. It took care of the first gap, actually went and closed the second gap, did some overshooting, who knows, maybe some stop losses, people get scared, whatever, you have no idea. So it became a very weird market day. But then we also have to factor in the fact that on June 14th they announced this. So again, if you own shares and warrants, if I have 50,000 shares and I have warrants, and I like my 50,000 share position. I don't let's say you're like, I don't want to have more than 50,000 shares in Barcelona. If you get money from, I mean, if you get just straight off money and you use it to exercise, you will have 100,000 shares. If you again want to keep the same position size in terms of share count, you would have to sell your 50,000 shares, pay for the warrants, get 50,000 shares back. So you still have a 50,000 share position, but given the incentive project, you also have a half a warrant. So what I think we saw yesterday, again, has nothing to do with the value of the company. The release or the news from pullbacking is good. We're showing there's one target is growing, which we've already drill confirmed, and we have got another huge target. And the drill confirmed target is still open, right? So that could be two, who knows? I'm not even going to put a number on, but it's like, yes, there's multi-million ounce potential just there, and it's 100% owned. So obviously a good news release. But when we factor in that a bunch of traders, which are prominent, I would say, and then you have the algorithms and all that, of course. So you have two gaps for traders to play with. So what it felt like, what felt like happening is like, you got to have a people that are looking for a liquidity event, because if you want to exercise, if you want to sell stock to pay for the warrants so you get your stock back, you need kind of a liquidity event. Because if you're sitting on 500,000 shares, there's almost no trading, and you want to exercise your warrants, but you don't have money, or you don't want to grow your position by that much, you need to sell shares. But you can't, because there's nobody buying. There's no liquidity. There's no trading. But if you have a monster day like this, there were 8.36 million shares bought and sold. And I believe a lot of that probably are people that sold shares to buy shares back via the warrant exercising. So they raise money by selling shares and buying back in the warrant program. So you had two gaps for traders to look at, and you had people selling to pay for the warrants. So we got a very interesting day because, again, volume absolutely enormous. So what it felt like happened yesterday, for example, is that we opened up high, the market was responding to the positive news release, and we held it, I mean, let's look at an hourly. For 3 hours, prices were kind of steady. Then it started to go down, and that's when I think that the gap traders were like, yeah, we're going to be able to close these gaps. So when they felt that there was not enough buying, and of course that this might be forced selling by people exercising the warrants as well, so they know, they all of a sudden got a tailwind. That's like, no, I think we're going to be able to close this gap. Then you just see red, because then I think is when they pushed hard. And like somebody said, I mean, this kind of artificial selling for no reason other than, again, you have traders with people motivated to sell because they're going to buy back the shares anyway. Those are the artificial dips you kind of like to see. I didn't actually plan on growing my position that much. What I typically do is especially if it's a long-term case like this, what I typically do is I've actually been averaging up quite a lot in First Nordic anyway, but that's because when I get more money or whatever. But usually if it's a long-term case, I usually ramp up my buying in dips, don't sell the rips, and then if I have something other to sell or whatever, let's put it like this. I'm not top or bottom picking. I didn't know today was going to happen. I didn't know we were going to have a candle like that. I didn't know this was going to happen, right? But it happened. So I simply react to the opportunities that the market gives me. Because the value of First Nordic went up on the news release, and we're already, in my opinion, way undervalued just based on Barsele, and this had nothing to do with Barsele. So the value went up, price went down, but we can figure out why the stock price behaved like this. Two gaps to be traded by gap traders, huge volume, warrant exercising, and since at face value the exercise price is 2.9, so at face value, theoretically there's like, yes, if I sell at 32 cents, I can buy back in the warrant at 29 cents. So you could book a profit all the way down to 29, but that's not factoring in the value of the actual half warrant. Especially if you think this stock is going to go higher over the next couple of years. This is basically a rounding error. But I think this is a good thing. Again, if we understand, now this is totally screwed up. Jesus. Okay. But my point is, like, when you understand what's happening. Well, first of all, this is what the case to me is all about. I don't really care what happens down here. That's not why I'm in this case. I think this is just, we're trading for pennies. It's down to 59 CAD. That's nothing compared to the value of Barsele and what they have. So it's like, to me, by definition, you're almost an idiot for selling down here. I'm biased and all that, but this is the opportunity. This price right now, this price range versus the actual, in my opinion, the intrinsic value right now, which I think is around here, and then all the upside potential. over the next 2 years, if we're able to, or next 3 years, or 4 years, or 5 years, if we're able to have some, positive surprises and we close this value gap, that's a multi-bagger. That's a big return. That's going to pay for a lot of other companies, for example. And I think there's a pretty good probability as well, because the Borsley project is not going anywhere. But my point is, if we understand it, if you have no idea how markets work, if you have no idea how trading plays into the daily life of a mining speculator, whatever, you just look at it's like, oh, that's a big red candle, heavy volume. But it's like, well, okay, I can understand how that works, because there were people get to July 7, which is not that far off, to get money and pay for their warrants. So they need money to raise, and if they want to keep the same size position, let's say, they need to sell stock, because they're getting stock back. Even if they're bullish and they're long and they want to keep their position, if they don't have any money and don't want to bloat the position, they're going to be selling shares. That combined with 2 gaps to close, so the traders are getting in. So it was like a trading fest yesterday, 8.36 million. So it's like, when you understand stuff like that, it's like, okay, for a long-term person, nothing changes. I mean, it's actually good that people, let's say, if people are selling to exercise their warrants, that means First Nordic is getting cashed up from yesterday's action. We're getting money. We're making it less probable we're even going to need a private placement anytime soon. So from a longer term dilution standpoint, and even medium term share price performance, that people are selling and using that to exercise, that's actually good. And at the same time, we got a discount, obviously, on the price of Borsley on a day that it went up in price. We have no idea. I'm just gonna. It's like, this is obviously speculation, but it's like, let's say we didn't have a bunch of traders and weren't exercise whatever. It's like, okay, to my conservative base case here, that's 290. At the close yesterday, that's here. Let's see, there. That's 406. This is what I keep talking about. It's like, you have no idea just how profitable the daily volatility can be over the long term. I'm not saying this is going to happen, but when First Nordic at least goes to $1.62 per share, if there was no artificial selling and trading and gap closing, whatever, and we would just keep going higher, yes, if the stock price ended up going like this, let's say, no real corrections, we're talking like a mechanical rise, this was the best buy, and that would have net you to 291, and obviously less the higher the share price went. But during the same day, possibly, based on, I think, the combination of traders, and these are short-term traders, to them, just closing a gap, that's a good trade for them. They're not in First Nordic for the longer term. They just see, oh, I see a stock with gaps. Okay, what happened recently? Oh, there's people exercising warrants. We probably, if we really push it, we can also, because they know that theoretically, at face value, it kind of makes sense that the warrant holders, they might, be okay to sell down to 29 cents, because that's what they get how much it costs to pay for the shares. But you also get a half a warrant, so theoretically, it's worth more than 29, so they could actually sell to maybe 28 cents, 27 cents. So knowing you have those kind of as your allies makes, obviously, I think, the gap traders more brave, let's say, because they know there are people that, even if they're, they like the store and all that, but they have incentive to, before July 7th, raise money, and that might be from selling stocks. So this was kind of a perfect storm for gap traders, I think, that you have a deadline and all that. But again, what they create for the longer term long, let's say, is possibly that, hey, okay, just by taking down the price, I actually bought some at around 32 cents yesterday. I wouldn't be surprised if it goes down to 29. And the beauty is that changes nothing. That means that there's more warrants getting exercised, and we get more and more cash to create even more catalysts without actually doing a financing. And of course, nothing happened with the actual value. So this is, in my opinion, a rounding error. And I didn't even plan on really adding much more, First Nordic, because my position is going up in price. My risk, let's say, my exposure has been going up in First Nordic. But I mean, for the long term, I'm not saying I'm going to be able to ride my entire portfolio. I mean, if First Nordic went to 1.62, it's like almost my entire portfolio would be First Nordic. So it's like I have to take profits along the lines because my position size is just huge at some point. But when price went down, that means I'm okay with even more exposure. And since my position size went down with price, so I have, at face value, I have lower exposure. And I think it obviously got cheaper because price went down, especially when value went up. That makes me want to have even more exposure. So I'm deep buying. So I don't try to, I didn't predict this in any way, shape or form. I didn't sell at the top and buying back at the bottom and all that. I don't predict where the price is going to go in the short term. I react. I actually like to pay for my additional shares of Barclays. I had to sell another stock. Not that I think is expensive, which I think is super cheap. It's just that it didn't go down like this. So that stayed, plus minus zero, whatever. I sold some of that because all of a sudden I think First Nordic, the expected return in First Nordic might be even higher than the cheap one I actually sold a few shares of. So this is what value shuffling is to me. Not predicting anything, but in this case, for example, realizing that, okay, these are warrant exercisers and traders piling in together, or the traders using the warrant exercises to create to manifest the gap close, and that's how they make money. They trade the gap closes. Okay, fine. And that creates then an opportunity for me as a longer term investor or longer term speculator, what have you. So okay, they created a flush, price went down, nothing changed for the value of the company. I think the value on a, again, fully diluted basis, I think my base case is that Barclays is at least worth 366 million CAD. And even with Rupert's and the current discount in the market, because everybody hates gold juniors, I think it should be at least at, let's say, 84 cents, which is a lot higher than 32 cents. And we were up at 40, so that's, I don't know. I mean, even in that case, this is like, okay, 100% hike, which is not bad at all. And now it's 165. So that is not something to sneeze at. If I think the very bare minimum, even in this crappy sentiment environment, I think fair value is at least here. And that's without anything happening on the exploration front, without anything happening with Agnico's drilling, just based on what is already known. If I can get an additional, if that kind of, let's say, probable return went from 100% to 65%, 65%, my very ambitious goal is to get 50% on my portfolio per year. 65%, a lot of people would be happy to have a 65% return over 3 years. So this is like a few years worth of returns created or the difference showing up in one day. Again, this has extreme consequences. That's why volatility, again, I react, I jump on stuff because we don't know. Okay, now let's look at I don't even have a upside case, but let's say this is the upside case. $3.15 per share. Then it just gets wilder and wilder. Now the return difference from the offered by Mr. Market on the same day at the open it was 660%. On the close, Mr. Market might have offered up an 883% future, let's say, blue sky return. That's over a 200% difference from 1 day's worth of volatility, thanks to traders and warrants execution, whatever you want to call it. And this doesn't take away anything from that either, because I bet if you buy it open, then you start feel very dumb all of a sudden, because the stock was up 17% or whatever it opened up at, and it closed down 8%, or what did it close down? 5.9%. I look like a total asshole. I'm 20% in the red in 1 day. Again, that's true, but is that even gonna matter? If the case was I'm buying First Nordic because my case is that I'm gonna be up tomorrow, that's the strictest definition of gambling, and that's not a strategy. If you have a long-term view of First Nordic that, hey, I think the value is a lot higher. Let's say it's around between at least $84 to $1.6. And I think none of this is priced in, which I think has a pretty good shot of happening. And this would be super material to have a 3 to 5 million ounce deposit. I mean, Great Bear was 5 million ounces. Rupert is like 4.1 million ounces. Is that material given the location and jurisdiction? Absolutely, of course. 1 million ounce additional could be like, I don't know, a few hundreds millions, let's say. So in that case, does it really matter? If we get to this, I only made 659%, versus the dip buyer made 883. We will be cheering like crazy if we got this return in the next 4 years, right? Goes without saying. But in the short term, most of the time I look stupid, let's say. Because I started buying, I think, like maybe actually 35 cents. And I mean, it went down to 31 or something. So I mean, yes, at face value, it's like, I'm losing such an incredible amount in such a short term period, whatever. But it's like, hey, the case has nothing to do, in my opinion, whether First Nordic trades at 40 cents or 32 cents on June 17th. My case is that anywhere even close to these levels look very cheap, only based on what we know about Barsele right now and what could happen in the future. So I mean, these are rounding errors. In a high risk, high reward sector, and I would say this is not the highest reward, highest risk case out there, given again we have an Agnico resource and all that. So I know a long rant, but I guess to wrap it up, it's like the point is that there's a ton of crap that happens in the short term. And most of the people that are acting in the market on any given day, they're traders in. Yeah, that's I think the thing to sum it up. I mean, in this case, yesterday I think we had gap traders specifically riding on the back of warrant exercisers. I get maybe you can say that. So it's like when you understand the stuff, it's like you stop being afraid and you don't take it personally, and you start to realize like, okay, well, for my case, nothing changed. Only the price changed. So it's like if I think the case is good at 40 cents and it went down to 32 cents because of traders, that just means the case got better at the close. for any, let's say, new money, whatever. That's why I value shuffled. Because all of a sudden the case was better. Nothing, I didn't predict it. Don't necessarily need to know why it happened, but it's obviously more comforting if you can figure out that, oh right, there were two gaps, and that's, there's a saying, all gaps will close and yada yada, and you see massive volume, and we know that on June 14th they announced the warrant acceleration, and we know the deadline is July 7th, so it's like it all makes sense, and then you stop like, okay, yeah, I know what's going on here. And it's nothing to do with the value of the company, nothing to do with, First Nordic was overpriced at 40 cents. Like, nope. I don't think First Nordic is even close to being overpriced at 40 cents. I think it's just, ridiculously cheap at 40 cents. It just got a bit cheaper thanks to the traders. So I've said this before, traders are what subsidizes really long-term investors, either on the upside or on the downside. Because let's say this break here, for example. Is there something magical about this line? No, there isn't. But traders are going to probably look at that break. And we had what it looks like, the classical retest or even retests. Is there something is there something magical on the upside or downside with that line? No. But traders look at that stuff. So if traders are like, every breakout needs to retest, so people sell. Well, it shouldn't retest because it should be trading up here already. But traders do that. Well, then I get a prolonged discount actually, and maybe it ripped more when the breakout happened because the value didn't go up, but it broke out. Then I get paid quicker than I might. Maybe than I should or whatever, or especially if we're going to whatever a true mania and there's obvious momentum to the upside, there's going to be momentum traders that are going to subsidize us. Maybe they're going to take our junior portfolios to valuations that are obscene. So it's like traders are not necessarily good or bad, but they do subsidize and create opportunities for longer term investors. If they keep a stock down because there's resistance, that means it's a prolonged discount period, right? Because there's nothing magical about a resistance zone. It's not price and value doesn't show up like that, right? The price and value gap. And in a breakout, maybe you get paid more than or quicker than you necessarily should. No news was out, it suddenly went up 30%. So that's like, I think the best way to look at it. It's like traders are not good or bad. Volatility is not good or bad. It all depends on what we do. If we only buy on volatile up days, volatility is probably going to work against us. If we are good at dip buying, let's say, and you have a bunch of traders that create dips, and you're a dip buyer because you're a long-term value investor, in that case it's like they create the opportunity for outsized returns because they're going to subsidize you on the price you pay sometimes, and they're going to over subsidize you on the price you can get paid for selling your shares one day. Yeah, long rant, but I hope it makes sense. I think this was just a very interesting case again, just to show that value might be absolutely unchanged. In this case, it actually went up, but it's like, but the share price on a given day has a complete life of its own. So it's like our job is to look through the price bullshit, figure out what the value is, see what the price to value gap is, and then make decisions from that. And in the meantime, the share prices will go up and they will go down, and there will be traders and there will be whatever, both on the upside and the downside. And we constantly, I think, have to have this longer view horizon. So and you know, think about, okay, how is the case changing on, you know, future expected returns with this volatility? Because like I already showed, that theoretically, if when we go to, let's say $3.2, I'm not saying it's going to be a 10 bagger, I'm saying theoretically, just 1 day's worth of volatility might have changed the future expected returns by 200% in 1 day. Years worth of returns within one single volatile day, because a gap trader showed up on the back of warrant exercisers. That's pretty remarkable, isn't it? It's like, you know, rings on the water, that in the short term it's like, oh, chaotic, and it's like, oh, 20%, something like that. In the longer term it's like, whoa, potentially, you know, 200% difference all of a sudden. Yeah. Anyway, long rant. I was going to talk about other stuff, but this dragged on as usual. No, I just think it's a very interesting case by how the market acts, and how, you know, the different types of people, like traders, long-term investors, and then you throw in, you know, a warrant accelerator, how that plays into you know, traders' hands. If they're gap traders, you have a gap to the downside, let's say, and you can actually see how the stock kind of, you know, held in there. There was a lot of buying, a lot of selling, and it's like, as soon as it kind of tipped over, I think the gap traders, they're like, okay, this is it. Let's drive it down. So they, let's say they short or whatever, and yeah, jump on it. It's like, good on them. You know, they might have netted 15%, I don't know, but it's like, whatever. I'm not after the 15%. 15% is a joke to me. I'm after pretty much nothing or a multi-bagger. Nothing or a 10-bagger. That's what I'm in for it. Yeah, that's it. Consider me biased. I own a lot of shares of First Nordic. I think I talked about Stillwater and you know, Magna a bit as well. I own shares of those as well. First Nordic, no, Magna and Stillwater are banner sponsors. Twice biased. Do your own due diligence. Non-investing advice. Bye.